And one of the common themes that I had was that, with all these SPACs trading down on the red days, I went and looked at a low risk opportunity. So I found some units, trading below $11. So if you're unfamiliar with SPAC units, the units are when they first price, they go public. A unit includes a common share and a portion of a warrant. So not all brokers allow you to purchase units. So that's, a key point here, that you can't buy units on, Robinhood or Webull, right? So that's another opportunity for a possible price jump down the road, because those units will split into common shares and warrants 52 days after the filing. So what I did was I bought some units trading incredibly cheap. So one that I bought was FSNBU. So this is a new SPAC from Fusion Acquisition, the same team that announced Money Lion. And these SPAC units were trading at $10.02 when I purchased them. Looks like they're a little bit higher today, but those units come with a third of a warrant. So I'm buying units at $10.02. I'm able to trade in common shares, right? If I don't like the deal that they announce, at net asset value, which is going to be $10 plus interest, plus I'm getting a third of a warrant. So I'm essentially getting a warrant option for free here. So that's a very low risk way of playing SPACs, is to buy some of these units that are trading closer to $10 now just because of that sell-off. I see a question there, Ruel. So PSTH was actually the exception. Those ones automatically split for brokers. But otherwise, yes, you need to call your broker to split shares. Now, you don't have to split shares. You can keep holding the units. But if you want to split them into common and warrants, you have to call your broker and have them split. Some brokers charge for that. I know Fidelity is one that doesn't. But, to each their own. Make sure you look at your broker fees, as that may be a limitation going forward. So up on the screen here, so FSNBU. So again, you get a full common share and you get a third of a warrant. So great low risk way of playing. Now, the thing is, you may have to be patient, right? They have up to 2 years to announce a deal. So you could be just sitting, parking your cash into this SPAC, and you may have to wait a couple of years. So, your risk here is the opportunity cost of maybe buying something else. But to me, with the market sell-off, I took advantage and I bought some of these units, that I saw on sale. The other ones were, KCACU. This is the same team that did QuantumScape, which was one of the best performing SPACs last year. So they issued units last week for their second SPAC. Now, normally on a green day, I would have expected these units to trade, over $11. But because of that sell-off, they traded down to like $10.80. And so people were able to buy units of a established management team that did one of the most successful SPACs, get those units under $11. That, seemed like a no-brainer to me. And then we had another one, TWLVU. So a newer SPAC group, but those units actually traded under $10 on day one. So you could buy in, and again, low risk. And I hate to say, no risk at all, but essentially that's what you're buying with some of these units trading at $10, because you get a common share that you can trade in for $10 plus interest, and you get a portion of a warrant. So you actually gain on your purchase with that warrant option that you can sell, down the road. So what do you think, Spencer, on that unit?
I like what Mike just said. As long as you accept or believe that it's unlikely that the stock could trade below its $10 floor, which is possible. Chris, you just said it happens. But as long as you accept that floor to be there, then it's kind of like it kind of sounds crazy to say, but it kind of is a cash equivalent. It kind of is.
Yeah, and and it almost seemed like the gift that the market gave us last week for me looking at some of these units. Again, when we had Julian Klimachko on the show, one of our first guests, he talked about, SPAC arbitrage, right? And using a heads I win, tails I win big. Yeah. And he, of course, with his SPAC ETF, he's able to buy these SPACs at the unit price, right? The $10. And then, he can sell those warrants, later on when they get issued. He can sell the stock when a deal is announced. He uses different strategies, right, to capture, gains down the road. To me, I can buy these units. I can wait 52 days and then I can split them. I can sell my warrants, or I can sell my common shares, take out my cost basis, this, play with the house's money with the warrants, and I just made my money back that I put into these SPACs. Again, I hate to say no risk, but you're getting, yes, a cash-like play here with some of these units. And we saw a SPAC sell off in October, and now we've seen one now. If you look at the times other than that, you didn't see a lot of units trading under $11, right?
Yeah.
Because units have that built-in common share and portion of a warrant. And you don't see a lot of warrants trading under $1.50. So, there's another one that I own, LEGOU and PUCU, PUCKU. Both of those, you get a full warrant with your unit. So you talk about upside, you get a full warrant. So there's LEGOU, trading under 1050, you get a common share and you get a full warrant. This company targeting renewables, infrastructure, and energy as well, which to me are high growth areas right now with the new administration. But it's an opportunity, right, where you can take advantage. You get that common share and that warrant. You also have the opportunity, again, when some of these other brokers start offering common shares and when warrants get offered, you could see a bump up, on that day. And then when a deal is announced, you could see a bump up. So you have several opportunities, to possibly get a good return. And if you don't see that pop or, get that strong return, you still at least don't have the high risk of some of these SPACs trading, over $12, $13, just the common shares, right? So
the other downside though is if for whatever reason they trade below their net asset value, and let's say you've got a large position, I don't know how liquid these warrants are. Chris, maybe you would know more than I, but I'm just saying I don't know how liquid. So if you need to get out, I don't know how easy that would be.
Yeah, and the warrants for the most part, again, most of them trade over $1.50. There are some that trade under $1, on ones that may have announced a deal that wasn't well received. Because again, a warrant is like an option, right? It gives you the opportunity to buy a share at $11.50, right. Is the most common on all these SPAC deals. So yes, ultimately, you have to find a buyer for your warrant. Your common shares, though, right? We know that when that deal is announced, you can reject and you can trade your shares back in for the net asset value. Mm-hmm. The warrants, you don't have that same opportunity. So there is a little bit more risk. And if a deal is not announced in the timeline, right, your warrants expire worthless. So that's the risk with the warrants. But that's why, again, I say if you buy units at $10.02, what does it matter, with that warrant? Because you just made your money back in the common stock alone. The other one that really surprised me last week that I bought into was Soaring Eagle. So SRNGU. Soaring Eagle raised over $1.5 billion. This is the management team that took DraftKings and Skills public, Harry Sloan and Jeff Sagansky. On a normal market day, when this thing went public, I would have expected these units to price over $12 based on that management team, based on the premiums that they demand. But you had units trading under $11 last week. And again, I think you only get a fifth of a warrant here. So you don't get a ton, on the warrant side. But I fully expect that these shares, when they're available to traders on other trading platforms, people are going to want a piece of this because they want to know, hey, what is the team that landed DraftKings and Skills? Yeah. What are they going to acquire next? So, we talk about SPAC management teams all the time, right? And Chamath jumps out, Michael Klein jumps out now with Churchill Capital. To me, Harry Sloan and Jeff Sagansky, they jump out because DraftKings and Skills, I think, were two of the best deals done over the last year. And, I'm betting on this one because I think they get another great deal.